my name is Ben Reppond. Welcome to my YouTube broadcast. Today is April 10, 2024. The stock market seems to be at an inflection point. It has gone up since the 1st of November to where it is today with very little correction, almost straight up. And now it's struggling. The question is it going to take a pause, take a breath, and continue up? Or is it kind of out of steam and needs to go back down for a while? We don't know that. But that is the question on my mind, and I think perhaps on the mind of a number of investors. Okay, let's get into the dashboard. This will kind of tell us what happened. This past week was negative. Not hugely negative, but it had some negative components. This is a chart which shows green dots and red dots to the right. And what that means is, going from top to bottom, these are indexes: the S&P 500, the NASDAQ 100, the developed markets, the Dow Industrials, emerging markets, etc. All the way down, the last one is the long-term government bond. And last week, all of these were green dots. Wow, 28 out of 28. Today, as of Friday, there were 20 out of 28. 8 of them turned negative, including all 4 for the long-term government bond. Wow. So you can see going down the left side, the ETFs and the indexes they represent. The yellow box contains the output or the outcome of last week for each of those. The worst was the long-term government bond, down 3.4%. That's a lot in a week. And of course, the Russell 2000 lost 2.7, the Dow lost 2.2, and others lost less. The only one that was positive was the emerging markets, and it gained a small amount. In the pink box, this is year-to-date numbers. So the S&P, and this is kind of how I ranked them from top to bottom. The S&P is on top with 9%, the NASDAQ 100 up 7, etc., all the way down. And then the long-term government bond has continued to be, all this year, has continued to be negative and is down 7.5% for the year. Now, what happens is traditional portfolios or traditional portfolio managers tend to put bonds together with stocks, or bond type investments together with stock or equity type investments. The common mixture is 60-40, 60 stocks and 40 bonds. But there are other percentage mixtures. They don't all use long-term government bonds. So some of them may use intermediate term bonds, or they may use corporate bonds, etc. But bonds are the price of bonds are a reflection or an inverse reflection of interest rates. As interest rates go up, or they are perceived to go up, or going to go up at perception, then bond prices go down, and vice versa. So with bonds doing so poorly this year, and with this week being a negative week for equities, this is putting a drag on a lot of portfolios. So I would imagine if you're in a traditional portfolio, you're barely eking out some kind of a gain for the year, and maybe you're even slightly negative. Well, this is why, because bonds are putting a drag on the portfolio. Again, your particular mixture may be different. So I just want to make that as a general statement. But you can see, as you go to the right of the pink box, you can see 5 out of the 7 that I listed all of a sudden turned from green to red. So it was definitely a negative week, but not sharp, not sharply negative, because the S&P was down less than 1% for the whole week. Okay, now we shift over to the S&P and tear it apart and look at the component parts, the sectors, the parts of the S&P 500. So you have 11 sectors inside of the S&P. Again, in my yellow box, this is last week. What was positive? Energy, extremely positive, 3.89% positive. Everything else was negative, and a number of them were negative by 2, 3%. Even retail down 5%. That's a negative week. Energy went up. This is reminiscent, to me. It's a bear market scenario. And so if that continues, I'm not saying it will, but if that continues, it's not uncommon to see energy go up and everything else go down, because it is a bearish kind of equity in negative markets. When you look at year to date, what's number one? Energy. And then it drops way down to get to financials, industrials, materials, and finally to technology. Of those top four, I would say all of them, or all of them except financials, at least 3 out of 4 are defensive or bearish sectors. What that's telling you is that the market is taking on a bearish tone. Now, what that could mean is the market corrects, comes down. It doesn't mean we're headed into a deep decline. It could, but it could also mean that we're just we're out of the growth stock phase and we're into value-oriented type sectors or stocks. And then you get all the way to the bottom year to date, and that's real estate and telecommunications, down 4% and 6%. Very negative on a year-to-date basis, as well as for this last week. Anyway, it gives an interesting picture. You start to see this is not the growth scenario that we saw some of last year. Okay, now we look at the chart. This is a weekly chart of the S&P 500, and it goes for a year and a half, and one move equals 1 week. And you can see at the very end of that, the far right, you can see where it starts to turn down, and that's the negative, almost 1% decline this past week of the S&P 500. But as you can see, the long-term trajectory is still in an upward direction and is still well above its 20-period moving average. When I put a relative strength chart, growth over value, growth numerator, value denominator, and when it goes up, that favors growth, and when it goes down, it favors value. So you can see over time, this 18-month period, over time, it has favored growth. And the chart shows that favors growth stocks for this past week. Even though I pointed out there are some value-oriented stocks that have done very well for this year, for this past week. With this going up, it tells you that growth this past week was in favor. And I would say since the beginning of 2023, growth has been in favor. Kind of a similar chart. You look at large companies to small companies. So again, relative strength. So when it goes up, this favors large companies, S&P 500. When it goes down, it favors small companies, the Russell 2000 IWM. And so it again had a move up that favored large companies, and since March of this past year has again favored large companies. Here's bonds. Now remember, I just told you how terrible bonds are doing, and that's because interest rates, or the perceived direction of interest rates, is up. And as interest rates go up, bond prices fall. So the long-term government bond ETF is TLT, and you can see the direction. This is a 54-month chart, a 4.5-year chart. So you can see the long-term direction and the short-term direction. You look at, since the late 2023 to present, it's been a downward decline, and this last week was down as well. So that it looks like the direction for now, at least, is that interest rates are going up, and at least on bonds, or the yield on bonds, is going up and the price of bonds is going down. The dollar continues to be strong against other currencies. So with all of our problems, including the deterioration of the value of the dollar, the purchasing power of the dollar, it is still looks a lot better than most other currencies. And a lot of times we're compared to Europe and Asia, but when compared to virtually any currency, our currency is strong. Gold has been surging. I can't think of another word except surging. So you can see in the last couple of months what has happened to gold, including the last 2 or 3 weeks. It's almost spiking. And so showing an extreme bias toward gold. This again is another bearish indicator. So if you look for, you look at the sectors of basic materials and energy, like I showed you earlier, those being top sectors. And then you look at this. All of this is combining to give you a value-oriented approach to the market and a bearish indicator, at least in the short run. I don't know how long it's going to last. My gut tells me not a long time, but for now, it's a bearish indicator. When you look at silver, silver did the same thing, but silver has been a little bit all over the map. So silver surged more than gold by quite a bit. When you really get this into a percentage, I'll show you later, silver had an excellent week. Silver tends to be more dynamic and tends to move more exaggerated more, both on the upside and the downside. But this was extremely positive for silver. And it struggled, so it needed a boost like this. When you put these on a relative strength chart, you can see silver, look at that spike up at the very end. Yeah, the longer term direction is still down, right? But when it goes up, that favors silver. So that's how much stronger this week silver was than gold by that spike up at the very far right. Bitcoin had a down week, nothing horrible, but it did go down this last week. But the long-term direction on Bitcoin is still in an upward direction. Volatility. So that beginning chart where I showed that there were 20 out of 28 green dots. So 8 turned negative. And then I showed you the sectors that had turned more negative. Well, even though the S&P only went down like 1%, less than 1%, the volatility index went up to 16. And so it was around 13, and it had been even down as low as 12. So a move up to 16 is a very sharp rise, showing an increase in fear. It's kind of a fear index of downward volatility of the market. I put a black mark up there so you can see where I use my discretionary indicator to say when it's above this. I believe personally that then we're heading into much higher risk territory, but we're still a ways away from that. So Asbury Research, they went from 6 green boxes to 4, and 2 of them turned negative. So again, not highly bearish, but showing more caution in the market by being 4 and 2. Okay, the cross-asset relative performance, comparing one asset type to another. So let's take a look at this. Stocks versus bonds. Which is more favorable? No surprise, stocks are doing better. Even if they struggle, they're still doing very well compared to bonds. Large cap versus small cap. We again saw that. Large cap doing better. The broad market, the S&P 500 compared to the Dow, doing better. The broad market compared to the NASDAQ 100 growth index, broad market, S&P doing better. growth versus value for the last three time periods, the last week, month, and quarter, growth has outperformed value. And I showed you that on the chart. The U.S. versus developed markets, U.S. is doing stronger than developed markets, mostly Europe and Asia. Bonds, government bonds or corporate, government bonds are doing better. So you saw how bad the chart was on government bonds. Corporate bonds are worse. High yield versus high quality. High yield is doing better. And short-term bonds are doing better than long-term bonds. Okay, U.S. versus the world. Now, this is not currency and this is not the economy. These are ETFs, which are an indicator of the equity markets in these countries. Ours is SPY for the S&P 500. But so comparing SPY to their equivalent of SPY, the ones doing better than us in all three time periods are Chile, Peru, Canada, Mexico, and the UK. The ones we are doing better than are Brazil, Switzerland, France, Japan, Hong Kong, China, and Thailand. So it's a mixed picture, but we're doing better than some, and some are doing better than us. I've been showing this, comparing us versus Switzerland, because the chart is so indicative. Switzerland, the ETF, is EWL. So if you wanted to buy the Swiss market, you could buy EWL in the US. But you can see on a relative strength basis how well the US market, namely SPY, is doing versus EWL, comparing one to the other. If it goes up, that favors the US. If it goes down, it favors Switzerland. Okay, so we covered this on the gold and silver. So as of Friday, the gold was up 4.3%, and it had been up for the previous couple of weeks over the Friday before or Thursday before, because it was a holiday. Silver, and that was a spot price of $23.28. Silver is a spot price of $27.45. It has really come up. That is an increase, believe it or not, in 1 week of 10.1% on the spot price. Wow, that is a lot. Both did well. Silver did even better, but it needed to because it was lagging. The gold, this brings the gold-silver ratio down from 89 down to 85 to 1, still favoring silver as a good value. The price of a monster box of 500 generic rounds, 1 ounce rounds of silver, so 500 of them, you're looking at a picture, is up from 12,000 and then 13,000 something last week, and now $14,345, definitely moving up. And the markup, this is what my son uses, is $1.24 per ounce. But that's an indicator of what, but some may be more than that, some could be less than that. This brings the cost per round in a 500 round monster box to $28.69. So you have two things going up. You have the spot price going up 10%, and you have the markup was $1 last week. I told you how crazy low I thought that was, and up to $1.24 this week. So the demand is up, and the manipulation on the spot price, in my opinion, is also up. When you get to a tube of 20, the tube is 50 cents more than that, or $29.19, including the markup. Buy gold. It's as good as, well, gold. It's as good as gold. I I think, I've said this before, that there is a place for people to buy gold or silver. My preference is silver. And to have that, and I prefer physical silver or physical gold. I don't believe in buying it in paper form like an ETF, and the reason, or a mutual fund, and the reason for that is the reason I'm buying it. I'm buying it as an insurance policy to protect me and my resources against the decline and maybe the eventual collapse of the dollar, or maybe a reset of all the currency systems, because they're all in trouble, not just the US. The US is among them, but as far as the eye can see, they're all in trouble. So if there is a reset on the currency system, maybe something that has tangible value, that has intrinsic value, like gold and silver do, will be valuable. I hope I never need it. I hope I never use it. And it's truly an insurance policy. And I don't look at it of, oh, the price went up today or it went down today and I made money this amount or I lost this much. I don't look at it that way. I look at it as if I do need it, I'll be glad it's there, and I hope I never need it. Thank you for watching. If you have questions or comments, leave them in the comment section below.